What's going on, everybody? Chris here from projectoption.com, and in today's video we're going to go back to the basics and we're going to discuss option moneyness. So you'll hear traders refer to options as being in the money, at the money, or out of the money, and today's video is going to break down what each of those terms mean. So what is option moneyness? Well, options traders often use moneyness to describe the relationship between an option strike price and the current stock price. Now, option moneyness refers to three specific terms, with the first being in the money, the second being at the money, and the third being out of the money. So let's go through each of these terms and go through some examples so you know exactly what each of these terms actually means. Now, starting with in the money, an in the money option is any option contract that currently has intrinsic value. Now, for calls, that means the strike price is below the stock price. So in this table here, we have the stock price, the call's strike price, and any corresponding intrinsic value that option has, and then that'll tell us if the option is in the money or out of the money. So the first example is a stock price of 100 with a call strike price of 110. Now that call has no intrinsic value, so that call would actually be out of the money. Now if the stock price is $125 and the call's strike price we're looking at is 100, that call actually has $25 of intrinsic value because that strike price is $25 below the current stock price. Now that option would be in the money. Now the same with the third example. If the stock price is $150 and the call's strike price we're looking at is $145, that call option has $5 of intrinsic value, and therefore the option is in the money. Now the opposite is true for put options, as in the money put options have strike prices above the current stock price. So if we have a stock price of $100 and we're looking at a put with a strike price of $110, that put has $10 of intrinsic value because the strike price is $10 above the stock price, and therefore that put would be in the money. Now if we're looking at a $125 stock and we're looking at a put option with a strike price of $100, that put option has $0 of intrinsic value because the put strike price is below the current stock price, and therefore that option would not be in the money. And lastly, if we have a $150 stock and we're looking at a put option with a strike price of $155, the intrinsic value of that put would be $5, and therefore the option would be in the money. So now that we've walked through in the money calls and in the money puts, let's look at a real option chain and identify the in the money options. Now in this particular image, we're looking at the Russell 2000 ETF with the ticker symbol IWM. Now as we can see in the top left there, the current stock price in this image is $137.21. Now if we look down to the option chain, we're looking at the May options. Now on the left hand side we have the call options, and on the right hand side we have the put options, and right in the middle we have the strike prices. Now as we can see, the strike prices of the calls that are below $137 are in the money, and this software actually highlights those options to indicate that they are in the money. Now the put options with strike prices above $137 are also in the money. So as we can see on the bottom right, the strike prices 138 through 142 in this image are the in the money puts, and as we can see, the software also highlights those options as being in the money. All right, moving on. So now we're going to talk about at the money options, and at the money options are really easy because at the money options just indicate options with strike prices equal to or near the current stock price, and that applies to calls and puts. So for example, if we're looking at a $100 stock and the strike price of the call and put we're looking at is $110, those options would not be at the money because that strike price is not near the stock price. Now, if we're looking at a $125 stock and we're looking at a call and put with a strike price of $125, those options would be at the money because the strike price is equal to the stock price. And lastly, if we're looking at a $150 stock and we're looking at options with strike prices of $160, those options would not be at the money because those strike prices are not near the stock price. Now let's go ahead and look at a real option chain and identify the at the money options. Now we're looking at the same image that we were before, and it's of IWM when it's trading for $137.21. Now in this particular option chain, we can see that there's a strike price of $137 for the calls and the puts, and that would be the at-the-money options in this case. So since the stock price is trading closest to $137, that 137 call and the 137 put would technically be the at-the-money options. Alright, now let's finish up with out-of-the-money options. Now, out-of-the-money options are options with no intrinsic value, and that means calls are out of the money when the strike price is above the stock price. So if we're looking at a stock that's $100 and we're looking at a call option with a strike price of $110, that call has no intrinsic value and is therefore out of the money. Now, if we're looking at a $125 stock and we're looking at a call option with a strike price of $100, that call has $25 of intrinsic value and is therefore not out of the money because it is in the money. And lastly, if we have a $150 stock and we're looking at a call with a strike price of $155, again, that call has no intrinsic value and is therefore out of the money. Now, the opposite is true for put options, as out-of-the-money puts have strike prices below the current stock price. So if we're looking at a $100 stock and we see a put with a strike price of $110, that put option has $10 of intrinsic value and is therefore not out of the money. Now, if we're looking at a $125 stock and we look at a put option with a strike price of $100, that put has no intrinsic value and is therefore out of the money. Now, I don't have to go through all of these examples, so let's just go ahead and look at a real option chain and identify all of the out-of-the-money calls and out-of-the-money puts. So to finish up, we can see that we have IWM again, and it's trading for $137.21. Now, to identify the out-of-the-money calls, we're going to look at the calls with strike prices above $137.21. So in this image, that's going to be every call option with the strike price between $138 and $142. And in regards to puts, the out-of-the-money puts are any puts with strike prices below $137.21. So in this image, that's going to be the puts with strike prices between $133 and $137. Now, while that 137 put is technically out of the money, since its strike price is so close to the stock price, it could also be considered at the money. Alright, so that pretty much sums up everything you need to know about option moneyness. So let's quickly recap everything that you've learned in this video. First and foremost, moneyness refers to the relationship between an option's strike price and the current stock price. In the money refers to options with intrinsic value, which means calls with strike prices below the current stock price and puts with strike prices above the current stock price. At the money refers to options with strike prices near or equal to the stock price, which applies to calls and puts. And lastly, out of the money refers to options with no intrinsic value, and that means call options with strike prices above the current stock price and put options with strike prices below the current stock price. Thank you for watching this video, everybody. I hope you enjoyed it. Please go ahead and take a moment to subscribe to our YouTube channel if you want to get all of our new video content as it comes out. And since we did talk a lot about intrinsic value in this video, if you want to check out that video, go ahead and click on the video link on the right hand side.